But appreciate you taking the time. For those that don't know who you are, would you mind giving a little bit of background on yourself, how you came to work in the position that you are, and how you got into crypto?
Yeah, so I've been in public accounting now for just under 10 years. Started in public accounting, still in public accounting, always doing tax returns. Focusing on real estate and construction companies for the most part. But that what kind of got me into crypto is back in 2020, the government sent us that stimulus check. And I didn't necessarily have a need for it at the time. So I was like, hey, there's all kinds of hype around crypto. Let me see what this thing's all about. So put some money into there, and continue to invest in it. Done everything that there is to do with it at this point. Done the DeFi, done the staking, done the airdrops, moving crypto over to cold storage wallet, etc. And this is before they had all these crypto tax softwares that were all advanced and everything. So I was keeping track of everything in an Excel document, keeping track of my cost basis, figuring out what my realized gains and losses were for these different airdrops that were coming in, etc. And then just being a tax manager at the firm just kind of picked it up and kind of just focused it on that little niche area of the tax code. So really just kind of from that and just from my own personal experience, just kind of build up the knowledge, and just kind of focus in on the crypto aspect side of the tax now.
Love that. Yeah. I mean, I think a lot of people probably find themselves in a similar position. I know many people watching. I got into crypto in 2020, kind of the same situation. Um, and that's where things started going. So,
Yeah, I mean, you really don't know anything about it until you actually get into it. That's for sure.
well, that's the deal, right? Like, there's so many professionals out there that work with people, but unless you've invested in it yourself and actually done the things, and that's how I ended up in the position where I am to be able to kind of curate this and partner with great people like yourself, is we can discern who actually does know what they're
Right.
doing, and oftentimes it does require that they have actual experience investing in the asset class.
Yeah, with crypto, it's hard to understand until you're actually in it. You understand you've done it yourself, etc. So
Yeah. So, we got we'll probably have about 500 people, watch this back. We got almost 200 people here with us. Um, where do you want to start on this? I mean, I've got like, the whole phone spiel here, but I'll think it.
yeah, so I mean, I think one of the important things is specifically with everybody that you've been working with is understanding the type of entity you're setting up and the tax implications that come with that. So I know for the most part, you're recommending single member LLC. So it's important for people who own these single member LLCs to understand how that information gets reported. And then yeah, I know some people also have partnerships, kind of what the difference between that is. But for a single member LLC, that is just considered a disregarded pass-through entity. So there's not a separate tax filing or anything like that that needs to be filed with that single member, which makes it really easy from a tax perspective. Essentially, on your personal tax return, there'd be a separate Schedule C where you will report all the crypto-related income and expenses. Um, and then with the partnership, it's a flow-through entity, but there's a separate tax return that needs filed. There's a separate tax return that would be filed, and on top of that, there's a lot more informational stuff that would need to be reported on that partnership return as well. So with the partnership return, you're reporting the balance sheet, you're reporting the capital contributions and everything like that. Whereas a single member LLC, the only thing that you're reporting is the profit and loss. So from a tax perspective, a single member LLC is a lot easier to report. Partnership is a little bit more advanced, a little bit more information that needs to be reported, etc. Um, Ultimately, all your capital gains and losses are going to flow through to your personal tax return, so it doesn't necessarily matter. But from like an administrative standpoint, the single member LLC is usually a little bit easier to kind of report. But with that being said, whenever you have these crypto LLC set up, you're going to incur crypto related expenses. And one of the questions that I get most often is, "Hey, I didn't earn any income this year. Do I need to report anything?" And while you don't necessarily need to report anything, it's going to be in your best interest to report some of these expenses. Ultimately, these expenses are going to help offset other income that you've earned, and ultimately help you out from a tax liability perspective. So some of the LLC expenses that I've commonly seen, working with some of your referrals and everything. Obviously, the legal and professional fees in order to get the LLC set up. Those are all valid business expenses. So those would all be deducted on the Schedule C and help offset other income that you earn. You got some dues and subscriptions that you're paying for your mastermind group. Those monthly dues that people are paying. That's all educational purposes for crypto related. All valid business expenses. Any office supplies or software. If you're purchasing any of these crypto tax softwares, those are all valid business expenses. Travel costs for any crypto related seminars, conferences, or anything like that. Whenever you do the meetups, all those travel costs, if the main purpose of it's for education, crypto education, etc., networking, you could take an expense for that. So like I said, I mean, even though most of the people are, even though most of the LLCs are just set up for crypto holding, you're going to incur some of those expenses, and it's important that you kind of pick up those expenses and help you out from a tax liability perspective. No, I mean, I know every year, I mean, you're not doing day-to-day operations, so you're probably not incurring all that many expenses. But I mean, generally speaking, I mean, if we could pick up $5,000-$10,000 worth of crypto-related expenses, depending on your tax bracket, I mean, that could save you maybe even $4,000 or $5,000 worth of taxes that you don't necessarily have to pay the government. So those are all the types of expenses that you want to look for. Those are all the types of expenses that you want to make sure that you're picking up on your tax return in order to just help you out from a tax liability perspective.
Yeah, I think that's great. And, kind of circling back to the single member LLC, we've recommended that for a long time as a disregarded entity. Allows, easy tax filings and administration for that corporation. Many people do choose to do a partnership between them and their spouse. There are 15 states where you have a QJV or a qualified joint venture, which would still allow them to be able to participate in a similar capacity and set it up as a partnership with no tax implications on the way in. So you want to touch on that for a second? Like when you're contributing assets into the corporation, what makes that a taxable event if you're doing a partnership versus a single member?
So ultimately, whenever you contribute to a partnership, whether you contribute to a single member LLC, whenever you're contributing to the LLC, the important thing here is that you record your contribution at your cost basis. If you record your contribution at the fair market value whenever you transfer it, then you theoretically have a built-in gain because the LLC is going to pick up the fair market value, and if the fair market value is obviously higher than what it was whenever you purchased it, then that LLC is going to pick up the fair market value as cost basis, and you ultimately have a built-in capital gain. So it's important that whenever you contribute these assets into the LLC, you're recording those at your cost basis. That way, there's not any capital gains that you necessarily have to pick up.
So let's say you do it at a later date. You just need to know what your cost basis is when you're contributing to the LLC, and that's the amount of money that you're putting in.
That you put in, yeah, and that's why I for all my clients that have been referred over, I always recommend getting one of these crypto tax softwares out there, especially if you've been purchasing for a long time. I mean, you can keep track on an Excel sheet. Some people do. Some people are very well organized and do it, and it works for them. But for most of us, we're just going to buy crypto and kind of move on from it. We're not necessarily creating an Excel sheet, keeping track of the date and everything like that. So it's important that you do keep track of that information for cost basis support. And also on top of that, from a tax planning perspective, having that software out there is really useful. I mean, maybe in a given year you're thinking about selling some crypto and you don't necessarily know what the capital gain is going to be. If you have this tax software, you can put in a sample transaction. Hey, if I sell 5,000 XRP, what's this going to do from my tax liability perspective? It's going to spoot out that answer right away. You're not going to have to do any calculations manually or anything like that. But yeah, like I said, that crypto tax software, there's multiple ones out there. But that's gonna keep track of all your cost basis and everything like that. Keep track of unrealized capital gains, etc.
Do you have any recommendations on the crypto tax software? I've used Coinly in the past,
Yeah,
like a free or
see,
anything.
I like Coinly. Coinly's very user friendly, easy to navigate. There's different ones out there. Coin tracking, Coin Ledger. Those are some other options as well. But for the most part, I usually recommend Coinly. Coinly's nice and easy. The nice thing about Coinly and all these other ones as well is you can actually, if you sign up for it, you link up all your wallets, all your cool storage wallets, etc., all the exchanges that you have. Um, the software is going to do all the work for you. It's really nice and easy. And then the nice aspect about it too is you can actually send accountant access to your accountant professional, and then your accountant professional is going to be able to go in there and view that data without having the individual send over all the transaction data for, I mean, who knows how many wallets that they own or whatnot. But I mean, so it makes it nice and easy from a tax planning perspective because I could theoretically go in, I can look at what the unrealized capital gains are for the year. And like I said, from a tax planning perspective, that makes it nice and easy.
Or losses.
Or lockers too, yeah, exactly. I know a lot of people reached out to me this past year regarding tax loss harvesting. So I mean, we can get into that if you want to.
Yeah, talk about the what's the rule that doesn't apply to crypto that's in
Wash
some.
sale rules.
Yeah.
The wash sale rule, yeah. So if you, so essentially, what the wash sale rule is if you have stock, and you sell that stock, you're not allowed to purchase it for a month. If you do purchase it within that month after you sell it, then that loss that you sold it for is going to be disallowed. So the IRS is not going to allow you to take that loss on the tax return. But for crypto purposes, that wash sale rule doesn't apply. So if you're sitting on some capital losses for the year, and this is, like I said, this is what happened a lot last year. But if you're sitting on some losses for the year, then essentially what you can do is you can sell that crypto that you have, trigger a taxable loss event to help offset any other capital gains that you have. And then if you have excess losses, you can just carry those forward and offset future gains. And then, but anyway, you sell the crypto and then you can immediately buy it back. And just kind of change your cost basis in the crypto that you have. And that way you take that taxable loss and offset other income that you have.
Yeah, we had a lot of people reach out at the end of last year. Some CPAs think that these are securities and or they don't know yet, and so they're kind of cautious about that. I'm glad you guys, kind of understand that it's not defined anywhere, and you can take advantage of that opportunity.
Right. Yeah. There's nothing that doesn't specify. But like I said, I mean, the IRS is treating crypto pretty much just like stocks. But there's nothing that says you can't take wash sale rules with crypto. So,
Yeah,
um,
take advantage while you can.
yeah, exactly.
Well, so what are some other strategies that you've seen people deploy to be able to mitigate taxes with crypto? I mean, you talk about the expenses for the LLC. Is there anything additional, if you are utilizing a corporate structure to maintain and manage the assets?
Yeah, I mean, so yeah, I mean, ultimately, I mean, you could set up family offices and everything like that, have some management fees go back and forth between the entities. There's all kinds of things that you can do. But I think one of the important things is realizing the difference between short-term versus long-term capital gains. There's a big tax liability difference if you have short-term capital gains versus long-term capital gains. So essentially, short-term capital gains, those are taxed at an individual's ordinary income rate, and that ordinary income rate just kind of depends on how much income you make, but those tax brackets vary up all the way up to 37%. Um, so if you're a high income earner, you sell some crypto at short term, you're picking up 37% of those capital gains, which is just going to almost kill you right there. So if you realize the difference between short term versus long term, that could really help you out. Long term capital gain rate, the highest tax rate for that is 20%, which is obviously going to be a lot better than paying 37% to the IRS.
Yeah. So, I mean, and that changes based on your income bracket also, right? I've seen people pay 15%, 20%. Where's the break on that for the long-term capital gains?
I've,
And
I've,
how does that?
I don't, you don't quote me on this, but I believe it's roughly around like 500,000 for married filing jointly. Is kind of where it goes. I think up to 90,000 for married filing jointly is 0% long-term capital gains, which is something to take advantage of as well. So I've had some clients that own other businesses, and those other businesses are reporting losses for the year. And those losses are kind of making their income very minimal for the year. So then at that point, what you can consider doing is selling some of the crypto if you need it from a cash flow perspective. Consider selling some of those long-term cryptos that you have in a capital gain, get that cash flow. And as long as you stay underneath that 90,000 file or 90,000 threshold, you're not going to get taxed on that long-term capital gains for the crypto at all. Um,
That's married filing jointly, right?
I
So,
believe, yeah, married filing jointly is roughly right around 90,000. And I think if you're single, it's roughly right around 40,000, 45,000. The numbers change on us every year. So I always, it changes every year, but it should be roughly right around that amount.
awesome.
And then one other thing to also just kind of go off of that is also realizing the different methodology that the IRS allows, whether you want to utilize FIFO, whether you want to utilize hypo, et cetera.
I, I thought at the end of 24 they made it where you have to use FIFO, and you weren't able to use the more exotic like LIFO or HIFO accounting mechanisms.
There's still some stipulation about whether or not it's going to be allowed.
Okay.
I know last year everyone there was the safe harbor plan as well.
Mhm.
And then as soon as the year ended, they ended up extending that to the following year. So I mean,
Okay.
yeah, there's all kinds of things that go into it. But even if you do have one, you should be able to file an election with the IRS to change that method. If you wanted to maybe switch between FIFO to HIFO. But yeah, it's important to understand the differences between those two. So if you're sitting on some high cost basis assets, consider maybe doing a HIFO for highest capital cost or highest cost basis,
This is
selling that first. Yep, exactly. But then again, that also comes back to it also comes back to whether it's short term or long term. I mean, there's benefits to each of them. Ultimately, it just involves a little bit of tax planning.
Yeah. Well, and you want to work with a tax professional that understands this stuff and they can make sure that it's done the right way. And you know exactly how much you can sell for that high FO if you made a large purchase at a high value versus, dollar cost averaging at the lower values. You only have so much crypto that was purchased there that you have to stay on. Um, and that's the problem. Like a lot of people just don't, like you said, they just buy at like I do, and I have to run it through the crypto tax software and work with somebody like yourself to make sure it's done the right way. Um, Do you have any other strategies? I mean, a lot of this is proactive stuff, right? That you need to be doing the last 3 months of the year, call it October, November, December, kind of leading up to the tax year. You and I talked about, one way that I've seen people do this. You can only do it once every 10 years, but you can, if you have a large liquidity event, you could backdate and change your financial year for your corporation once every 10 years and move it kind of like the month before you had the liquidity event. So then you have the whole next 12 months to be able to write that off or figure out how to mitigate those taxes.
Yeah, exactly. Yeah, I mean, yeah, like you said, there's all kinds of different things that you can do. The timing of the capital gains crucial, kind of just like you said. If you're in December and you need some cash flow, and you're looking to sell some crypto, but you have high income that year, maybe just consider selling it January 1st. That's going to prolong the tax that you need to pay. That's going to essentially prolong it an extra year. So that's just another deferral strategy. Like I said, the tax loss harvesting is a big one that we do at the end of the year. Um, I like to, whenever I talk to my clients, I always like to try and touch base with them, like you said, in October, November, December, because that's a huge tax planning opportunity for people. Understanding kind of doing a tax projection, understanding what your tax liability is looking like for the year. What are some things that we can do to try and mitigate these taxes, maybe defer some of these taxes, et cetera. That's a big tax planning opportunity in that fourth quarter of the year. Um, but also another thing to consider is crypto IRA retirement accounts. That's a big one.
That's what I was going to say. So, like, I mean, let's say that people weren't proactive at the end of last year, right? And they're looking for a way to offset some of the tax implications they have this year. Like with a Roth, you can do backdate 1 year and this year for the contribution and write those off. Can you do that with like a SEP or a 401k?
Yeah, so you can do it with a SEP, but not a 401k.
Okay.
Um, but yeah, I mean, essentially, I mean, traditional IRA crypto accounts. I mean, you're deferring all that tax until you pull it out of your retirement account, which could be years from now. And the thought process behind a traditional IRA is if you're making a lot of money right now, take that deduction if you can, defer that tax, pull it out later in life whenever you don't have as much income. You're going to get taxed on that at a lower income rate. Now the counter side of that is nobody knows what the tax rates are going to look like in the future, but I mean that's just the world we live in. Nobody knows.
Hopefully, we have no crypto capital gains.
You know, that's what I'm hoping for, but we'll see what happens. But then, yeah, Todd, to go on that, other than the traditional account, you also have that Roth account as well. And a Roth account is something that a lot of people are interested in. You put that money into a Roth account, you don't necessarily get the deduction for it this year, but that crypto, I mean, that's going to grow tax free to you. And I mean, who knows what crypto is going to look like in the near future, but I mean, if that 10, 15, 20 years from now, I mean, if XRP is shooting up to $100 or something like that, you don't have to worry about paying any tax on those capital gains whenever you purchase it at a dollar or $2.
Yeah. We have a product that allows you to aggregate, through an algorithmic trading strategy, more XRP and also a cash position inside of that because of the trades that it does. I think we're the first people to market with that product. Um, the downside to an IRA is you can't margin or borrow against the principal, right?
Okay. Yeah.
So, We have a lot of people that kind of do both. They'll keep some in their LLC and they'll put some of it, or have some cash flow and fund an IRA or a Roth, and that's kind of their like long term bag that they know they're going to be able to access in retirement. And then they have a portion today that they're able to access and get cash flow off of and margin and do other stuff with in the shop.
Absolutely. Yep. Absolutely. Yeah. And if you do put it in, there's requirements in order to pull it out. You can get penalized if you pull it out early. So it's just something to think about. Theoretically, if you're putting it into an IRA, you shouldn't plan on touching that money until you're over that 59.5 years.
Yeah. Yeah. So if you're earlier in life and you have a long time horizon, it can compound a little bit, can go a long way.
Right.
Right. Like you said, and in the Roth, you're going to pay the tax up front, like you mentioned. But I mean, what is it now? It's 6,500 per year till you're 55, and then 7,500 after 55 that you can contribute.
I think in 2026 it's 8,000. And it was I think it was 7,525, 8,000 in 2026.
So up to 7,000 for anybody under 55, and you could backdate 1 year. So you could, potentially put 14 grand in a crypto IRA. And if it was invested in the right assets, you might see, you know, 100, 1,000x. You got Peter Thiel, who has a $5 billion Roth IRA because he invested in PayPal stock
Yeah.
uh, early on. So, he's gonna be just fine when IRA.
Yeah, I like Roth IRAs, just because the other I see that money in the account and I know that I don't have to necessarily give any of it up. It's nice to see that money grow, knowing that whenever I hit that age, I can pull that out. I don't have to worry about even thinking about tax liability regarding it. Uh, so that's just my own personal preference.
Yeah, I think that's great. So we talk about some tools and strategies here. Um, other things that you wanted to mention or run through. I've got
Yeah. So yeah, I mean the crypto backed loans, those are a big things. I mean, if the interest rate's right, the interest rate's most likely going to be better off than what that tax rate's going to be. So if you can kind of if you can kind of use your crypto as collateral in order to take out a loan, um, pay that interest off with the different funds that you're offering, and not have to worry about any tax rate. You get the cash flow, and you don't necessarily have to worry about a big tax liability or anything like that. So that's a great opportunity right there.
we've had some people, have some issues with that just because of market volatility. So that's always a consideration, right? Like these aren't assets aren't fixed. But as long as you have the means to be able to service the debt and then you can meet a capital call if there is one, I do think that most people have had a lot of success with that to be able to, get more of a position if they wanted to do that, or, be able to take that out and live their lifestyle. The whole concept of infinite banking, right? Like if you're borrowing against an appreciating asset, you don't have to deal with the tax implications or the capital gains, and you're still able to take that, quote unquote equity out of that and do something else with it. That's what the wealthy do, right? They borrow against their assets.
Borrow against it. Yep, absolutely. I know this past year was probably a little bit little rough with the XRP not appreciating like we all thought it was, but I mean, theoretically, if XRP continues to appreciate over these next few years and whatnot, borrowing against it is really not necessarily going to be that big of a deal.
Um,
You're gonna have an appreciated asset that you have collateral with. So
yeah, and I think interest rates will come down on things. We're currently somewhere between 10 and 15%, depending on how much you're borrowing and what asset it is. But to your point, that's still less than the 20% even long term capital gains if it's over $500,000.
yeah, yeah, absolutely. Another thing that I wanted to mention that maybe not a lot of people are aware of are qualified charitable contributions with crypto. That's a big one. It's almost like a double tax benefit for you. Number one is essentially what you can do is you can donate long-term appreciated assets. And if you donate that, number one, you're going to avoid the tax. You don't have to pick up a capital gain on the assets that you donate. And then number two is from a tax benefit, you actually get to deduct as a charitable contribution the fair market value of what that asset is whenever you donate it. So that's another thing if people are into charitable giving. That's one of the nice things about appreciated crypto that you have. You know, get rid of that crypto. Don't worry about paying capital gains. You get that charity deduction, and you get that charity deduction at fair market value.
Yeah, we do that with charitable remainder trust. We've seen a lot of people do donor advised funds.
Yeah,
Built that as well.
for a big opportunity. Yeah, absolutely.
Yeah, they're, I mean, there's a lot of different ways you can make an impact with things. We've had some people set up private foundations, which is a little bit longer and more expensive process, right? And there's a lot of compliance that goes around that to do it the right way. But we've had, like I said, a lot of success with people doing charitable remainder trust with their crypto in kind. We have a way to do that. There's a lot of people that will tell you you have to liquidate it inside there and then restructure it. We've got products and solutions where we meet the requirements to be able to keep it in crypto inside of that charitable remainder trust. When you do it that way, you're actually going to be able to take some income back out of that versus just giving the whole thing away to a charity. But
Right.
charities today will, take your crypto. I promise. A lot of them are going to sell it once they get it, but yeah,
Nope. Yeah. Yeah. I mean, like I said, if you're a charitable person, that's one of the ways to give it. And then not have to worry about paying any big capital gains to it. The other thing that you can do is gifting crypto to family and friends.
Mhm.
I mean, it's like kind of like income shifting. So if you have some friends that are in a lower tax bracket or whatnot, and you're looking to maybe help them out, you can essentially gift them that crypto, and then you're not going to pay any tax on the income that you get. Also, gifting the family members is the big thing. Gifting the kids. Now, the thing about kids is you got to be aware of the kitty tax rules that apply to that. But yeah, gifting crypto is another great opportunity. Um, and then one other thing that I thought of, and just this is just because I've been in real estate prior to kind of focusing in on the crypto aspect side of the things, is qualified opportunity zones. So if you don't know what a qualified opportunity zone is, it's a zone designated by the IRS, where if you invest in real estate in that zone, you can actually defer the capital gain that you put into it. So, for example, if you sell crypto and have a $500,000 capital gain, and don't quote me on these rules, I'd have to double check, but I think it's within 6 months, or maybe, yeah, I think it's 6 months. So if you take that capital gain, and you invest it in a qualified opportunity zone, you hold that real estate, your investment in that for over 10 years, that $500,000 capital gain that you have, that gets wiped away. You defer that tax and you don't ever have to worry about paying tax on it. Typically these qualified opportunity zones are in lower income areas. They're kind of incentivized to kind of help people build up these lower income communities. But that's a great way, especially for people who are interested in real estate. Take that capital gain that you have, put it into a qualified opportunity zone, and defer that tax. You don't have to worry about paying any tax on it. And then, like I said, if you hold it for up to 10 years, you're never gonna have to pay tax on it.
Yeah. Well, and you get the depreciation on that property too.
You get depreciation on property, everything involved with the real estate, all the expenses associated with it, etc. So yeah, that's a great opportunity for people who are interested in real estate.
Yeah, I think we'll see a lot of people diversify, on the other side of price appreciation for a lot of these assets. That the people that I've seen be successful in crypto, they continue to buy assets with the gains, and if there's a way to be able to mitigate the taxes while buying assets, you know, again,
But
great way to do it.
yeah, absolutely.
Um, I had to hear that you wanted to talk about kind of some crypto scams. So, we unfortunately have had a lot of people participate in Ponzi schemes, have assets taken from them, either through email phishing or other means. How can you write that off? Like, is that a thing?
Yeah, so you can write it off. The important thing is just to keep documentation regarding it. The IRS, it's a pretty heavily scrutinized area, and the IRS can come back and kind of question why you're taking these expenses. So number one is you want to make sure that you're keeping all the documentation that you can. You want to be filing a report with the FBI and the Federal Trade Commission. File a report, get that report in writing. That way you kind of have documentation to kind of go back and support that. But yeah, well, essentially anything that you lose from a crypto scam, it can be written off as casualty and theft losses on Schedule A of your tax return.
Yeah, so that could be huge for people. I mean, if you had a pretty significant amount of income the previous year or other capital gains, is it able to offset income, or is it only the capital gain side that could be applied to?
No, so that it's gonna offset income. So essentially, what's gonna happen is whenever you file your personal tax return, you're either gonna take that standard deduction that the IRS gives you, or you're gonna itemize your deductions. So essentially, the government gives you, I believe this year's like 31,000 or 33,000, somewhere right around there. for a married filing joint couple. So essentially, you're going to get that $33,000 deduction no matter what. But if you itemize your deduction, meaning if you have more in taxes or state and local taxes that you pay, more in mortgage interest, more in charitable donations, some medical expenses, and then theft losses. If you add all that up and it's more than that $33,000 standard deduction, then you're going to take that larger deduction and offset other ordinary income that you have. So it's not only going to affect capital gains, it's going to affect ordinary income.
That's I mean, again, I hate that that has happened to people, but I think that at least there's a kind of a silver lining there,
Right. Yeah,
in that
absolutely.
situation.
I mean, it's just being aware of who you're talking to. I mean, people are in person. I'm sure you probably get impersonated all the time.
Oh,
Um, yeah, people impersonating. I mean, we get emails all the time pretending that my boss is emailing me, and really he's not emailing me. I have text messages from my boss got to me that he needs to upload information, and I know it's not true. So it's just being aware of being aware of it. If something sounds sketchy, then it probably is. It probably is.
yeah. Just want to be, like you said, aware of what's going on and double check. What I have a lot of people do is if they think they might be talking to me on another platform, they'll shoot me an email or they shoot our team an email, and immediately we're like, "That's a scam. That's not us." And that just helps save people from making that mistake. But again, if unfortunately you have had that happen, if you're working with a good CPA, at least you're going to have the write off to be able to.
Yeah, we have some clients, they sometimes get hacked or something like that, and they'll send us an email, and I'm like, "This person doesn't sound like this doesn't sound like a normal email from that person."
Yeah.
And the first thing that I do is I'm calling that person on the phone and asking me if they sent me this email, and for the most part, they're usually like, "No, that was not me." So maybe calling the person as well was another good opportunity.
Yeah. And well, I just want to double check. And I mean, what I've got from your note here is there was $17 billion worth of losses in crypto.
$17 billion in losses, and a lot of it nowadays has to do with just AI enablement. I mean, AI is just unbelievable nowadays. I mean, they can do they can do pretty much anything. They can make it sound legit. They can word it how you need it to word it, etc. So AI had a big part of that.
On kind of just switching gears here, you also had written down like R&D tax credits. So is that for people that are like developing things in crypto or can you
So yeah, so there's some research and development tax credits out there that the IRS can allow. Um, and if you're doing any research, developing any new cryptocurrency or anything along those lines, it doesn't only necessarily have to be with cryptocurrency. I mean, if you're developing new software or anything like that, anything that you're working on developing something new, um, there's research and development credits out there available for you. That could help you out in the future, help offset help you from a tax liability perspective. Um, so those are things to look at whenever you're kind of looking at developing new cryptocurrency, et cetera.
and we've worked with families that are actually planning to utilize the crypto in their business. So there was one payment processor that's a family office that we've talked to, and they were able to write off their investment in crypto because they plan to use it in the business to facilitate the transactions and participate in that. Because this is software, right?
Right. Yeah,
And
exactly.
these tokens are for the use of the network. Sometimes you're paying fees. I mean, banks, the OCC just regulated last year that they could hold digital assets in order to be able to pay the fees to participate with payments on the networks. Um, so, if you are, to Dylan's point, developing something in the space or planning to use this for actual business transactions, and it can't just be like, yeah, yeah, I'm going to do it. You have to have a real tangible thing that you're going to use it for. So, I'll give you an example. Let's say you had a logistics business, right?
Mhm.
You do last mile shipping or something like that. If you bought a bunch of VeChain and you plan to utilize that blockchain to be able to facilitate that and participate on the logistics component of how that's being implemented, you could potentially write that off, right? Um, and again, back to the payment processor, XRP, XLM, um, he has that. If you do trade finance and you're planning on using XDC to facilitate transactions within your business, or other tokenization of bill of lading or other paper products that have some type of value that you can then sell or exchange to somebody else, all could be tax deductible. So let's say you do that, right? Like you write the crypto off. Would you have to recapitalize those gains if you were to sell it in the future?
So how it used to work was if you and they changed the rule. But essentially, if you had any research and development costs, what you had to do was you had to capitalize those costs and amortize them. And then you'd have to amortize them over, I believe it was a 5-year period, which wasn't necessarily beneficial because you're incurring all these costs and you're not getting full 100% deduction for it. But that recently changed. It's back to 100% deduction now. So you can take all those research and developments and take those as a deduction now. It's huge. Pick up the R&D credit. That it was a huge part of that one big beautiful bill. That's really going to help out people.
So, I mean, the only other thing that I think we skipped over here, and we got a lot of questions in the Q&A channel that I want to get to in the last 20 minutes. Section 179. So we talked about the software piece of that. What about a vehicle? If you've got a vehicle that you use exclusively to go meet people, have conversations, do business, go to educational seminars and events, is that tax deductible if it's over
Yeah.
6,000 pounds?
Yep, over 6,000 pounds, you can do 100% write off. The important thing is it has to just be used for business. If you're using it for personal use at all, then you need to document those personal use miles. And then essentially a portion of that depreciation would get disallowed if you're using it for personal reasons. But yeah, I mean, if it's a business vehicle, you're using it 100% of the time for business. Then yeah, over 6,000 pounds is a section 179, 100% depreciation deduction.
And if your wife is a manager in the business, you guys go out to dinner and have a conversation about how you're going to make investments, and it's documented on the receipt.
Yeah.
And what about food and other things like that? Is that
Yeah, I mean, yeah, the wife's a manager. You're going out and you're talking about these investments, talking about the business. Maybe you're talking about kind of structure, anything like that. Looking about projections, kind of looking forward to the future. Anything like that. Those meals will be deductible. Now, meals are only deductible to 50%. But I mean, still, that's still
every penny counts?
yeah, absolutely.
Yeah, you're viewing the dollar at that, right?
Yeah, absolutely. Yeah, on that receipt, you should be documenting kind of what the meal was, the purpose of the meal, what was discussed, etc. That way, if the IRS ever comes back, you have that receipt to kind of provide to them and let them know exactly what was discussed, the purpose of it, etc.
Yeah. Just it's documenting.
Yeah, absolutely. Keep documentation for all the invoices, receipts, anything like that. It's important that you hold on to those. I believe the statute of limitation is 3 years from the time that you file your tax return for them to come back and maybe question anything. So it's important that you're keeping all that documentation that way in case an IRS audit does happen or something like that. You have that support, you have that documentation to back it up.
Yeah. The only other thing that I want to touch on before we move into the questions here, a lot of these exchanges are issuing 1099 DAs at this point. So you're using that, Coinly software, but like, let's say you use multiple exchanges, they're going to have to know your basis. Are they just going to take whatever you bought it at and then calculate those trades to be able to draft that 1099 for what's available on their platform?
Yeah, so I mean, it really depends. So if you bought something on Coinbase and then subsequently moved it over to a cold storage wallet, and then maybe after 2 years moved it back onto Coinbase, Coinbase is not going to recognize what you paid for that asset. So the 1099 DA, it could report the cost basis as long as you kept that asset on that exchange for the entire time and didn't move it. But very few people do that nowadays. So those 1099s are essentially just a report to the IRS to let the IRS know, hey, this person sold crypto and here were their total proceeds that they received from it. So it's then on the taxpayer to kind of calculate what that cost basis is, and make sure that they pick it up on their tax return so they're not paying full tax on whatever the total proceeds are. And then from our perspective, if you're using any of that Coinly or any of these tax software packages, our job is what we're going to do is we're looking at the 1099 DAs, and we're making sure that the total proceeds that we're reporting is at least the same, if not more than what the 1099 DA shows. Because if we're reporting less than what the 1099 DA shows, that's going to be a red flag to the IRS. So we want to make sure that the total proceeds that are being reported are at least, if not more. Generally, they're going to be more. Just because not all exchanges are going to be required to file those 1099 DAs. So if they're not a U.S. exchange, then they're not going to even issue you a 1099 DA. And the other thing too is the 1099 DA, that's not going to report any like airdrops or anything like that.
Well, that's where I was headed next. Like, what if you do staking or airdrop farming, or you're generating income to a cold wallet? Like,
Yeah.
that tax software is really kind of your only option.
The other option is keeping it in an Excel document, taking the fair market value of the date whenever you received it, plugging that in, and then totaling it all up for the year. So yeah, like I said, the crypto tax software, it's well worth the cost. I recommend it to all the clients. It's going to save me. It's going to increase my efficiency, etc. And nobody wants to be bothered with the hassle of looking at their airdrops every day, plugging in the value of what they receive, um,
Yeah.
and keeping track of that. So,
Well, let's jump into some questions here. Jody's asked, do you guys have a minimum in order to be able to work with y'all?
no, we don't have a minimum. We work with everybody. Kind of how our firm's billing rate work is we charge per the hour. So I always tell my clients the more organized, the more well documented you are, that helps keep my efficiency down. It helps keep it relatively pretty effective. I don't necessarily want to go through individual receipts and total these all up. If you give me a nice spreadsheet that has all the expenses for the year, that helps keep our costs down. But yeah, there's no starting fee for us. Generally, what happens is we charge a 250 retainer fee, and then that 250 retainer fee just goes towards your first invoice. But yeah, like I said, generally speaking, most of the referrals that we gotten from you generally range anywhere from about 500 to about 1500. Really, it just kind of depends on kind of the information that you give me if you're using the crypto tax software, etc. Also, it depends on what's also included on your personal return as well.
Right. Well, if you have, other income and other things outside of a W-2 that are, K-1s and all of that, that could be a little bit more complex. So this person says that their CPA is not allowing them to take deductions for the expenses on the holding company that they've set up. What would you say to that?
I mean, it's a valid business expense. You have an LLC that's set up. You're incurring expenses with that LLC. I mean, it is a business expense.
Well, that's what I try to tell people, but there's a lot of, CPAs out there that are very,
Yeah. Some CPAs are just a little bit more conservative. Um, I like to think that we're relatively. I mean, we're going to do what we can in order to kind of maximize deductions. I mean, we're not going to bend the rules or anything like that in order to take a deduction. We're going to make sure that we're staying in compliance with all the IRS rules and regulations and everything. But if there's an argument to take a deduction, then we kind of have that support court case to back it up or anything like that. Then we're going to go ahead and take that deduction and let the IRS come back and question it at that point if they want to.
yeah. If somebody's day trading and somebody's holding long term, we normally recommend that they set up two different companies to be able to do that because the operating agreement's going to be different. The benefit of trading company in my mind is, you're taxed on the total loss or gain at the end of the year and you're not on every single transaction like you would be otherwise. The downside to that is it's always going to be income. There's never any long-term capital gains inside of that. But if you're trading all the time anyway, that's what it's going to be irrespective. So any thoughts there? Have you seen both?
Yeah, I mean, no, you said it. You said it exactly right. Day trading, that income, the capital gains and losses are going to be disregarded because that's going to be ordinary income. So depending on how much you make or anything, that could be taxed up to the 37% tax bracket, just depending on what your taxable income is for the year.
Yeah. Which, if you did really good, you have a bunch of expenses, right? You might have traveled or you might, use an algorithmic trading bot that you pay for or other stuff. All of those expenses are deductible off of that income that you made.
Yeah. Yep.
This person says uh, he had to set up the LLC with personal money. Does that pierce the corporate veil, or like, you're exchanging that value for the equity in that corporation to set it up with the initial capital contribution? If you added more money to it, as long as you're documenting that with a written consent or written action, that should still maintain the corporate veil for creditor protection. Is that accurate?
Yep. Yeah. Absolutely. Anything that's maybe paid personally. I mean, well, the other thing too is I always have a lot of people ask like, I paid for the LLC setup before I had a business bank account. I mean, you're not going to have a business bank account to even pay from it if you don't have the LLC set up. So yeah, you would essentially, if you're paying from a personal bank account, you're just gonna classify that as a capital contribution, and then you're just gonna pull that expense right out, and ultimately you're gonna get net zero, and then pick up the expense and then pick up the capital contribution.
Right. This person says, can the deductions for expenses be deferred to the next year if there's no income for the current year on the business and personal tax liability isn't improved by the additional deductions?
So I mean, if you the expense whenever you report the expense, that depends on whether you're a cash basis or a cold basis. So if you're cash basis, then you're supposed to be reporting all the expenses whenever that's being paid. If you're accrual basis, then you're supposed to be reporting those expenses whenever they're incurred. So that's another aspect of kind of thinking about setting it up. Generally speaking, we usually always do cost basis, but there is some benefits to doing accrual basis every once in a while. But even if you don't necessarily have any income for the year, I mean, you report those expenses and you don't necessarily have any other taxable income for that year, then you're just going to have a net operating loss on the tax return. That net operating loss can get carried forward and offset the future.
Yeah. Well, so you'll be able to roll them forward.
You'll be able to move forward. Yep, exactly. We do that with the home office expense a lot of times. So for the home office expense, you're allowed to take a deduction for the home office, but if the Schedule C for the LLC doesn't have any income and you're showing a net loss, that home office deduction is disallowed. You're not able to take that deduction in that current year. But what you can do is you can roll forward those expenses to the future and offset future income that you have.
Oh, that's great. Well, and what's the total on that? Like up to 130 your home or a certain number of square feet that you can.
Yeah, so I mean, there's a simplified method and there's an actual method. The simplified method is I think $5 per square feet of the home office. That's generally the little bit of an easier one. So, but there's also the actual expenses where you just take the square footage of your office, take the entire square footage of your entire home, and let's just say your home office is 5% of the entire home. Then essentially 5% of the real estate taxes that you pay, 5% of the mortgage interest, 5% of the utility bills for the home, those would all be deductible home office expenses. And like I said, even if you can't utilize it that first year, you can at least carry it forward to the future.
Yeah. Is there any benefit to people filing an extension versus doing it at the beginning? I see a lot of business owners do that. Is that just to, a- aggregate more income so that they can fund for the previous year in a 401k or the IRAs, or like what are the other benefits of filing an extension versus just going ahead and take care of it?
I mean, so I believe, and this is probably more for audit, but for audit purposes, I think the pooling for audits, there's more that's usually pulled from in before the filing deadline. So I believe if you file an extension, the audit pool there or the pool of returns that are selected to get audited is actually less than what it is before the filing deadline.
Interesting. So you're less likely to get audited if you do an extension.
I believe that to be true. Yeah. There's a larger pool of returns before April 15th that gets selected. And I mean, many people file an extension. I mean, filing an extension just gives you an extra 6 months to file. The important thing about filing an extension though is it doesn't give you extra time to pay. So if you do expect a liability for the current tax year, and you want to file an extension, you should still send in an estimated tax payment to what you think that's going to be. That way, you're not hit with any penalties and interest. Like I said, the extension gives you an extension to file, not to pay.
Not to defer the payment.
Not to yeah. The IRS wants their money on April 15th, no matter what.
Yeah. Corvette says, I'm assuming these techniques work for individuals who don't have an LLC too, since it's a pass-through entity. Is that correct? I would say, I mean, you could operate as a sole proprietorship. Um, you'd still need a DBA in order to be able to do that. But I mean, do individuals get these offsets? Do you have the full breadth of the tax code if you're not utilizing a company?
Yeah, so I mean, if the IRS comes back and ever questions any of those expenses and they don't see an LLC associated with it, they can call that a hobby rather than an actual business. So if you have that LLC, you're kind of active in that LLC, doing all kinds of different things with it, learning, doing these education classes. I mean, constantly kind of just looking up information, doing different trades, etc. You have an LLC, you have an actual business. Whereas if you're trying to claim those expenses without the LLC, IRS can come back and say, hey, this is not a business. This is just a hobby that you're working on, and you can't take hobby losses.
Right. T-Max says, I transferred my assets over to DWP in December. Was that a taxable event? No, it's not. It'd be just like moving it from an exchange to a cold wallet. I mean, taking cash out of the ATM and putting it in your wallet. there's no tax implications. You're just moving an asset.
Anytime you move crypto from your personal exchange, personal wallet, anytime you move it over into the business wallet, Anchorage, anything like that, it's going to be a non-taxable event. Like I said, the important thing is just making sure that you transfer that cost basis associated with it. If you are contributing it to a crypto LLC wallet.
And then he also asked about like a laptop and the mastermind. But if you bought a laptop specifically to, research crypto and do things in that guidelines, like using it for personal stuff, obviously wouldn't be business oriented. But would you be able to deduct the price?
If the purpose of the laptop was for crypto holding, then in order to do these research and everything like that, then yeah, that's absolutely a business expense. The other thing that we generally like to do is we like to take a business use of cell phone and internet. So like home internet at your home. There's an argument to be made that, hey, part of this should be on the business because without that internet, I wouldn't be able to do what I'm doing. I wouldn't be able to operate this business. So it's important to kind of look at what business use percentage is versus personal use percentage, to try and help pick up some additional expenses.
The next one on here is about the bankruptcies that happened back in 2021. So they said they never paid taxes on the sale, but wasn't asked and understand back then, 2019, 2020. So like, let's say that something goes into bankruptcy and you finally get some type of distribution for that bankruptcy. Is there some type of write-off that you'd be able to get for the difference in value for the asset today versus?
So that's a good question. A lot of people actually had that whenever these bankruptcies happen. So essentially, let's just say, for example, you had $10,000 of cost basis in crypto assets, and then the exchange went under. What you can do is you can take that $10,000 and write it off as a capital loss. However, if you end up recouping some of that money at some point in the future, then you would have to pick that up as a capital gain. But if you never actually took a capital loss for it, and let's just say your basis was 10,000, you recoup $5,000, you can write off $5,000 as a capital loss, because that money's lost.
Right. What if you got one of these crypto cashback cards? So you spend money and they give you 3% back in crypto or whatever. Is that income for you when they give you that distribution or those assets for the interest?
That would be considered reward. That would be considered reward income. It would just get reported as other income on your tax return.
Okay. So you still want to be keeping track of all that stuff like airdrops and all these little things. They add up as income.
They do add up. Most people don't think much about them. I mean, maybe you're earning a few bucks here and there and everything like that. But whenever you're earning airdrops every day, maybe on different exchanges, different blockchains or whatnot, I mean, it can add up. Um, but yeah, all taxable income.
This person says, "Do I need an LLC and trust to gift my crypto?" No, you can gift from your personal name and still get that deduction. What's the total amount this year that you like $19,000 worth of crypto?
19,000 for an individual, 38,000 for a married filing jointly. So as long as you're under, so if you gift under that 19,000, then there's not a gift tax filing return that needs to be filed or anything like that. But you would still want to make sure that you have documentation on that gift. That way, if the IRS ever kind of comes back and question how this person received that asset, you'd have documentation to show, hey, I gifted this crypto on this date. Here was the cost basis of it. Here was the wallet address that it came from. Here's where it went, etc.
Yeah. So and people have asked me like, can I gift crypto and keep it in the same wallet? The answer is no. You should have a separate wallet address that you send that crypto to, and then it's on a public blockchain. It shows exactly when it was transferred. You could look up the price at that time, and that's their cost basis. And there's an actual transaction that took place for that gift. This person says, I have DWP LLC and an IRA. I transferred 150K in kind from the IRA to the LLC. Is that considered personal income? What strategies can be used to offset taxes? So I don't know if you have an IRA LLC or an IRA trust, or if you set up, something separate that's just a normal LLC. But if you took money out of your IRA to fund the LLC, you would owe the penalties and the taxes. Now, that could be a good thing depending on when you did it, right? If you did it at a very low cost basis, um, and you had appreciation since then you have a lot more access to those assets and you can do a lot more things with them, but you are still going to owe the penalties and the taxes for that transaction.
Yeah. I mean, the other thing too is it depends on whether it's a traditional or a Roth. I mean, on the Roth, you're not going to get taxed on the contributions that you put in, but you'll get taxed on the earnings since the contributions.
Okay. Well, again, you just want to work with a good CPA. I would encourage somebody. This is an anonymous person that posted that on there, but reach out to Dylan and his team. And how many guys do you have now? You have 2 other people there alongside yourself that are more crypto savvy.
We're growing it. Yeah. So I mean, I think now we're roughly around. We're at 3 people right now. We're looking at hiring someone else, specifically just to do kind of crypto related tax returns and everything. Get them caught up to date with everything that you're doing. Get them up to date with these income funds. Like I said, the K1s that are coming in, et cetera. Just get them up to date. Keep them updated with everything that's going on, just to kind of help us out. Because like I said, I mean, crypto's not going anywhere. And one of the biggest problems with CPAs right now is most people don't even want to be bothered with it.
Right.
So the more people that we can have kind of involved in it, understand it, ultimately we think as a firm that's more beneficial for us. Just because it's kind of that niche area of the tax code. Like I said, that most people don't want to necessarily be bothered with. So we want to take advantage of it, kind of work on specializing in it.
Yeah, I love it. When you have the LLC and you're going to file as an S corp, if you didn't make any income, it's a disregarded entity, and pass through. Um, what what if you have this person says, I own an S corp. Uh, what if you own an S corp and you now have an LLC as a disregarded entity? So I'm assuming they have 2 separate structures. There'd be 2 different tax returns for the
Yeah,
structures.
the S corp files its own separate tax return. That tax return gets filed, and then that tax return generates a K1, showing the owner's taxable income from that S corporation. And then on your personal tax return, you pick up that K1 income from the S corp, and then in addition to that K1 that you received, you'd have the Schedule C for the crypto LLC.
There you go. This person says, no question, just a comment. Dylan is amazing.
Oh, thanks.
I've only started working with him and have nothing but wonderful things to say. I appreciate the mastermind and for recommending him. Thank you for having him on. Absolutely. Dylan's been great. We love Welcome. Um, and that's the feedback we get from everybody, by the way. Flowers to you guys. Y'all do a great job of being proactive, communicating, taking care of people. I really can't say I've ever had anybody come back and say they didn't have a good experience with you guys. So
Yeah, that's good. Glad to hear. Yeah, I mean, the number one complaint that I get from clients that are kind of looking for a new CPA is their current CPA just doesn't get back to them. It takes weeks, maybe sometimes even months for them to answer an email or whatnot. So I try and take some pride in making sure that I'm keeping my clients all updated. Even if I can't necessarily get to something within the next day, I will at least try to acknowledge the email, let you know that I saw it, that I'm working on it, etc. Sometimes communication goes a long way. So that's something that we try and pride ourselves on.
yeah, y'all do a fantastic job. And I know you said you wanted to share this with some of your people and you kind of wanted a little background on me. I know we're doing this kind of backwards. But I figured, are you good if I close with that?
Yeah, yeah, absolutely. Yeah, because we have some of our clients watching as well, or maybe not watching right now, but are gonna watch. That just kind of want to learn a little bit more about you, kind of what you're all about, kind of what these LLCs do from a legality standpoint, why the Wyoming LLC, etc.
Yeah. So, just a background on me. I made a bunch of money in crypto in 2021 and I couldn't find anybody to help me. So I called a bunch of different firms across the US and whittled it down to the 5 people I worked with to be able to structure my estate, mitigate taxes and set things up the right way. And then started talking about that on social media in 22. Some people were nice enough to make some intros to some family offices. We started consulting for them. And then over the last 3 years, we built out a full end-to-end spectrum of private client services for people that have a significant allocation, whatever that means to them for crypto. And so, you mentioned the LLC. We do that. We've done probably 7,500 Wyoming LLCs to manage and hold digital assets. We set that up as a holding company that manages alternative investments with a specific sleeve for crypto. The reason we do it that way is it makes it a little bit easier to get a bank account. If you have a trading company and you walk in and you say crypto in a bank, they're not going to set up an account for you. They might be a little more apathetic to that now, but over the last 5 years, it's been kind of a taboo subject to even bring up. So when they ask you, you say, yeah, we do private equity and real estate and other alternative investments. And we use that, use this entity to manage those. The benefit of Wyoming, there's, 3 You get, really strong creditor protection there. So, charging order protection, very similar to Nevada, as long as you're maintaining that corporate veil. You get the anonymity because it's attorney-client privilege. Use the registered agent's address on the filing so that your home address is not listed on there. Your name's not listed on there. If anybody goes to look it up, they can't figure out who is associated with that corporation. The laws there in Wyoming are the most favorable for digital assets of any state. They've been the most progressive. And then last but not least, like, you mentioned there, you get the full breadth of the tax code to be able to offset the income and gains that you have if you're structured this way. Whereas if you're doing it in your personal name and you're trying to do it as a business, there's not a legitimate business entity there for the IRS to look at and, make the determination that they are legitimate expenses. So, we've been, clicking along with that. We do a bunch more complex estate planning, on the philanthropic side and on trust structures. We have insurance, then the wealth management, right? So we have institutional custody over there at Anchorage. You have an individual account, segregated bankruptcy remote, insured up to $100 million. Wallet address where your stuff sits there. And then we do have some fund vehicles where we've been able to generate returns for people on their digital assets. We started with XRP, and we just launched our Bitcoin product with Fidelity toward the end of last year, and we'll continue to roll out products and solutions to allow people to generate additional cash flow and compound their investment in a lot of different capacities. So,
Oh, and what's the minimum that you have to have now in order to kind of get on board with you?
yeah, with 50,000 is the minimum for the wealth management side, but we'll do an LLC for anybody as long as you have an allocation to crypto. Most of the time, we start to see people entertain that around $50 to $80,000 in total portfolio value if they believe it's going to go substantially higher. And the reason, that's kind of the area that I think it starts to make sense is a lot of these are going to move very quickly to the upside. And if you're seeing 50 or 100x or 1,000x returns on some of these digital assets, as we see, the adoption of the protocols and networks, the gift tax threshold comes into play here in the US, right?
Right.
Um, if you have a large liquidity event and you and your spouse are trying to gift more than $30 million out of your taxable estate, champagne problems, I know. But it becomes an issue. So the sooner you can structure things the right way and gift those out of your taxable estate, you would have to file a 709, tax form for that gift. But that moves it out. And then you you can structure things and mitigate the taxes that way. Because anything over that you're trying to gift out and even pass on to your kids, if it's in your personal name, is going to be taxed at 40%.
They're gonna find a way to get their money.
Yeah. So you want to be proactive on this stuff. When I was younger, I didn't like talking about death or any of that stuff. And like, unfortunately, it is a reality of the world that we live in. We're not all going to, live for forever. And so you want to be, I can tell you, had my dad been a little bit more proactive, I would have been really appreciative of that when we had to go through his stuff. So, but then, we're here to provide value any way that we can, just come alongside as advisors and help people navigate this stuff as they do come into a lot of money in the asset class. And again, appreciate you taking the time out to, hang out with me and answer good questions and kind of give people some insight on how to mitigate taxes and do this the right way.
Yeah, absolutely. I appreciate you having me on. Like I said, it's been awesome working with you. Looking forward to continuing the working relationship that we have.
Yeah, absolutely, brother. Well, this is recorded. People will be able to listen back to it later. We'll share you guys a copy so that you can share it with your group. And yeah, cheers to the relationship and to many years to come.
Awesome. Thanks, Jake. Appreciate it.
Yes, sir. We'll see you, Dylan.
Yeah, we'll
Thank you,
see you.
guys. Appreciate you taking the time.